What was the currency school's policy recommendation? What they said was, well, we can prevent this, okay? We have to go beyond the gold standard. We have to prevent banks from issuing notes, okay, in particular the Bank of England, beyond the amount of gold that they held, okay? Now, this was a marginal rule. What they said was any note that was issued had to be backed by the full face value in terms of gold. In other words, what they wanted implemented was a marginal 100% rule. Every expansion in the supply of notes in the economy would reflect gold flowing in to the banks from abroad, okay? Or people depositing gold in the banks. So no new note, unbacked note, would ever be put into circulation again. And they got this passed. Okay. Unfortunately, it didn't stop the inflationary booms or the ensuing recession depressions. Okay. Well, why not? Well, unlike the American currency school, who followed the British currency school, they did not, or they neglected to, or ignored the fact that bank deposits, checking account money, was also part of the money supply, and therefore that this marginal 100% rule should also apply to checking deposits. So what the banks did then was to inflate the supply of checking account money in the economy. Okay, that is, increase or inject fiduciary media, unbacked money substitutes by loaning, not notes, but by increasing deposits, by loaning money out through increasing deposits. Okay, and as a result, we were stuck with this, Britain continued to suffer from the business cycle. Now, during the brief period when the currency school triumphed, during the period when the act that implemented this law was passed, people began to use inflation according to the currency school definition, which was use the term inflation as the currency school defined it. That is, an increase in the money supply that exceeded the amount or increase in gold. Okay. So one American financial writer, Charles Holt Carroll, who was an American currency school writer, he wrote that the source of inflation and of the commercial crisis is in the nature of the system which pretends to lend money, but creates currency by discounting such bills when there is no such money in existence. Okay? So he went on to say, instead of using gold and silver for currency, they are merely used as a basis of the greatest possible inflation by the banks. So it was, he said, it was the artificial increase of currency only, meaning the amount of currency that was put into circulation beyond the gold stock, that was causing the problem of inflation and then later depression. Okay. And then in the last quarter of the 19th century, the greatest American monetary theorist, Francis A. Walker, also believed that inflation was an inherent feature of the issue of even convertible banknotes that could be converted into end deposits. Okay, these convertible banknotes and deposits that could be converted into gold, if they were issued beyond the stock of gold, if you had fractional reserves banking resulting or that was in place, then, in his words, there resides in bank money, even under the most stringent provisions for convertibility, the capability of local and temporary inflation. So what he was saying was that even where banks stood ready to convert these notes and deposits into gold, because they were issuing these notes and deposits beyond the stock of gold that they held, you would get inflation. So this is not a new and invented definition by Rothbard. Okay, it was the older definition of inflation. On the other hand, when the currency school was discredited by the continuing business cycles, again because of the defect in their policy, which did not apply the 100% marginal reserve rule to checking account money, then the banking school, their opponents, their definition of inflation came into play. It still referred to the money supply. Okay, it didn't yet refer to just an increase in prices, But their definition was that inflation was an increase in the money supply, not beyond the stock of gold in the banks, but beyond the needs of trade. Okay? So if somehow there were more people that were trading, that, according to the banking school, would be reflected in the fact that more borrowers would come to the banks, more business borrowers, demanding loans. And that the banks had the right then to discount these loans, or had the duty to discount these loans, and it would not be, or to discount these bills that they were being given, increase the loans, and that this would not be inflationary. So that definition of inflation began to replace the currency school Rothbard definition. And what was pointed out by opponents of the banking school is that the banking school could increase the needs of trade as much as it wanted. It could just simply lower the interest rate. The lower the interest rate, the more businesses would want to borrow. Okay. So the banking school would say, well, look, businesses are coming to the banks and they want to borrow. So we have, because they want to borrow, that means that their needs of trade have expanded, and it's proper to fulfill those needs by increasing lending. But all this did was to drive up the money supply, okay, and cause inflation. So to conclude this here, Rothbard's theory surely is not new, and to say that it is unacceptable is simply to express one's agreement with the preference for the banking school over the currency school definition. By the way, the banking school definition that inflation was an increase in the money supply beyond the needs of trade was one step away from the modern definition that inflation is simply an increase in prices. Because the American quantity theorists later on, okay, Irving Fisher, Edwin Kemmerer, who were early quantity theorists in the United States, they basically said that inflation occurs whenever the country's circulating media, and by that they meant money and deposit currency, increase relative to the needs of trade, okay? Because when they went beyond the needs of trade, they drove prices up. So it was a short step in the 1930s to then redefine inflation as simply an increase in prices, okay? Now, Timberlake also challenged Rothbard's statistical definition of the money supply on two grounds. First, Rothbard included savings and loan share capital, okay? There were institutions, savings and loans, that were owned by their depositors. Okay, so when you went and deposited money into a savings and loan, you were not given a checking account, or you were not told that you were a depositor. You were a shareholder. Okay. Now that meant that in some sense you were an owner. So that was the first thing that Timberlake objected to. Now, secondly, Rothbard also included the life insurance net policy reserves. So, Timberlake claimed that Rothbard included these two items in the money supply as a way of trying to make the 1920s look like a more inflationary decade than it really was. Okay? And he went on to argue, Timberlake did, that the two items in question are not money because they cannot be spent on ordinary goods and services. To spend them, one needs to cash them in for other money, that is currency or bank drafts. Okay, so let me take these one at a time. First, the share accounts offered by savings and loan associations were fixed at $1. Okay, so if you put $1 into your account, then you got $1 of a share in the savings and loan. Okay, but they were back then, and always have been, okay, even until through the 1980s, we had savings and loan associations that were owned by their depositors and issued share accounts, and savings and loan associations that were owned by stockholders, and they issued savings accounts. But economically, the accounts were exactly the same, okay? In both cases, whether it was a share account or a savings account, you could withdraw your money on demand at par. So if you had $10,000 worth of shares in a savings and loan, okay, you could immediately withdraw that. In fact, the savings and loan associations were contractually obligated to repurchase their shares at par upon the request of the shareholder, but they could legally delay the repurchase They could legally delay it, okay? Just as savings and loans could other savings and loans, the savings and loans that issued only savings accounts, they could delay it too by insisting on 30 days notice. Okay? Neither institution, neither type of savings and loan institution ever, or to any extent, insisted on previous notice, let's say 30 days notice before they would allow you to withdraw your shares or your deposits. Okay, and in fact, one commentator points out that for many years, savings and loan associations have made the proud boast that every withdrawal paid upon demand, or some similar statement. Okay, so it's certainly true, as Timberlake claims, that shareholders had to trade their share accounts in for currency or bank drafts. Okay. But they got them at par and on demand, okay? And then they were able to spend them on goods and services. So there were really no difference in savings accounts. Let's put it that way, okay? Rothbard was simply recognizing that a legal technicality shouldn't stand in the way of identifying something as money when essentially it functioned as money, when essentially your share account allowed you to withdraw readily spendable dollars, okay? And they were just as readily spendable as dollars that were held in commercial bank savings deposits, okay? Which, by the way, Timberlake does include in the money supply, okay? In his definition of the money supply, he includes savings deposits offered by commercial banks, which are the same thing, okay? All right, now secondly, regarding this point, he does not object to Rothbard's inclusion of the savings deposits of mutual savings banks in the money supply. Okay? Although mutual savings banks are also were owned by their depositors, so he doesn't object to that, and they're identical in their function to savings and loan associations, and were also technically mutually owned by their depositors. But he doesn't object to people including their savings deposits, okay, that people could withdraw on demand, though subject to a never enforced 30-day notice in the same way. Okay. So why then does Timberlake insist so vehemently on treating the liabilities of these two institutions, both of which are supposedly owned by their shareholders, so differently? Okay. Well, it goes back to Friedman and Schwartz. Friedman and Schwartz, in their book, their great book, excluded the share accounts of savings and loans and of credit unions from their definition of the money supply on the grounds that these institutions are technically not banks, as defined in accordance with the definition of banks agreed upon by the federal bank supervisory agencies. Okay. Since, quote, holders of funds in these institutions are, for the most part, technically shareholders, not depositors. Well, who cares that they're technically shareholders? And who cares what some bank regulatory agency says? This is just simple, legalism, substituting for economic analysis. Okay. These items are part of the money supply precisely because people can interchange them at par on demand for checking accounts or for cash.